Hello, I'm Alex Barrett, Head of Client Research at Standard Chartered Bank, introducing our global monthly, which this month is looking at the outlook for H2 2010. Against the backdrop of a slowing world economy, we look at whether there's likely to be a double-dip recession. We conclude it's not particularly likely, and that the strong growth that we're seeing across many of the emerging markets will outweigh the slowdown that we're actually seeing in many of the Western markets. If we look at the fiscal consolidation that's taking place in Europe and elsewhere, that's going to have an impact on global growth. But it's going to have a couple of implications. First of all, it means that interest rates are not going to be raised anytime soon, and that's not just in the West, but also it's starting to impact the more robust markets as well. We've already seen that Australia has gone on hold and Indonesia hasn't raised rates on the back of the concerns over Europe. But secondly, it means that growth has got to come from somewhere. And we believe that that is going to be coming from China and other parts of Asia. The concerns over a collapse in Chinese GDP growth we think are overdone. Yes, there will be a moderation, but China has plenty of tools left in its kit bag to be able to restart growth. And if anything, they're just really slowing excessive growth rather than actually slowing down to any reduced rate. The key going forward for the key asset classes will be what happens with that growth and also with confidence in investors. If we look at the commodity markets, first of all, we've got reasonably robust growth coming through in China, but not at the same levels that we saw earlier on in the year. So base metals have been weaker. But we believe, even though we'll see some volatility, we're getting close to a point where those prices will bottom out and will start heading up towards the end of the year. If we look at oil, OPEC continues to manage the overall supply very well, and therefore we don't expect much downside. And as the growth in Asia and many of the emerging markets continues to be reflected in growth in consumption of oil, we're expecting the market to tighten towards the end of the year. And where we're currently sitting at the 70 to 75 level, we're expecting by Q4 we're at $80 to $85 a barrel. Soft's outlook is a little bit mixed and will depend a lot on the weather. We have the La Nina weather formation forming in the South Pacific, and that will be determinant of many of the soft prices going forward. And finally, on the precious metals, with concerns still over many of the currencies and many of the risk aversion trades still coming on, we're expecting a good bid still for gold and other markets. Moving on to credit, much of the credit returns that we've seen in the first half won't be repeated in the second half. We're looking more towards some of the relative value trades across Asia, though in the big picture, Asian credits should still continue to outperform Western and particularly European credits. If we look at currencies, volatility will be the key. The macro changes that are playing out between the West and the East, and even within the West, will be reflected in currencies. And the expectations for growth differentials and also rate differentials will be absolutely vital. There's likely to be volatility with Eurodollar, but also between Euro-Asia and Dollar-Asia. Within Asia, our preferred bet is for the Indonesian rupiah. We like some of the other currencies as well, including Korean won, but we don't like the likely volatility that they're going to see. We see the Indonesian rupiah as the low-risk, high-return option, particularly with a big, generous carry. And finally, if we look to rates, against the backdrop of Asian rates where we've possibly got a slowing of the rate hikes, we're still expecting inflation to be a concern and ultimately rate hikes to start again by the second half of the year. Therefore, we're still expecting markets to flatten, so the front end of the yield curve to rise more than the back end of the yield curve. And again, looking for value within these markets is a bit difficult, but Indonesia stands out with a high yield, and actually now that they've put their rate hikes on hold, likely at a slower pace of rate hikes going forward. Elsewhere, we're still constructive on some of the other markets, but we prefer to keep our powder dry until we've seen more clarity on when rate hikes will recommence. Overall then, we're looking for a slowing of the world economy, but not falling into a double dip. We're expecting Asia still to outperform the West, and many of the big cyclical trades that we have on and have in our minds remain completely intact, though with volatility in the short term. Thank you and have a nice month.